Okay, hello everyone. Welcome to the revision session for December attempt. And the topic is risk and uncertainty. Okay, what is risk and uncertainty? At times when we are launching a new product or starting a new project, actually uncertainty prevails in the market. Uncertainty prevails in terms of cost, in terms of revenue, in terms of demand. Okay, we can't really predict now what would be the cost would be, for example, we see if the cost can be 10, it could be 12, it could be 13. This is about the uncertainty prevailing in the market. We can't really predict when we're taking a decision. We can't really predict what actually cost would be. Maybe we can assign the probability to it, that there's 25% chance that the cost would be 10, 25% chance that the cost would be 12, but there's 50% chance that the cost would be 13. Actually, the sum of the probability should be equal to 1 or 100%. So also, just like in the same way, we cannot predict the demand, okay? Because these are certain uncontrollable factors. Based upon certain uncontrollable factors, we cannot control it. Maybe there may be uncertainty prevailing in terms of selling prices. We're thinking it could be 10, it could be 15, it could be 20, and the probabilities we are assigning according to that. But probability, how does the probability come from? The probability comes when we actually have done a similar thing, probably launched a similar product in the past, and we have a recurring thing going on. So we have a past data because the event is very recurring, is repeating over time, and we have a couple of data, and from that we can actually predict about the cost and the revenues and the demand at times. But when we don't have the past data, this is how we quantify the risk. So the risk, the two things, risk and uncertainty. When we're launching a new product, I'm talking about the demand. I don't really know what could be the demand. Demand could be, that's what I feel. Demand could be 70% chance that the demand would be 1,000 or 30% chances that the demand would be like 2,000. That's what I think. But if a product is new, and I don't have the past data, and also if I'm launching a new product, definitely it won't be a recurring nature product. So definitely my estimation could go wrong. What I would think that the probability or the chances of occurrence of that particular thing is this, definitely it may go wrong. Okay. So one thing we need to understand about the risk and the uncertainty. Risk is when you actually can predict the probabilities for each outcome that you have estimated. Okay. You can assign probabilities to it, but at times you are so uncertain, uncertainty is at its top, that you cannot assign the probabilities to the possible outcomes. These are the outcomes. I'm saying these are the outcomes, that the cost could be this. This is the outcome of my decision. Revenue, selling price could be this, or the demand could be this and this. This is the outcome. But when I actually can assign the probabilities, that is, I can quantify the risk element in it. That's the risk. But when you cannot quantify the risk, that means the probability is not known and you cannot predict or estimate the probability statistically. That means it's uncertain. So risk is when probabilities could be assigned. Even then it could go wrong, right? Our decisions could go wrong. And what we are thinking, actually it may turn out to be a little different. But due to past experience, since it was a repeated nature kind of a thing, a recurring thing, we could actually assign the probabilities. So probabilities could be assigned is when it's risk. But uncertainty is when probability cannot be assigned to your outcomes. No, probabilities cannot be assigned. What are the chances of the earthquake? If I talk about here, our area is not a very earthquake prone area. We don't have the past record for that. So maybe any area in which it's not a recurring thing, earthquake, I cannot assign the probability. But if it's any area which is actually earthquake prone area, you can actually, as per the past data, you have the past data, you can actually predict how much are the chances that it would be earthquake and how much are the chances that it would be not. Okay, so this is about. So we all know the risk associated with so here I was writing probabilities cannot be assigned. This is uncertainty. Okay, we do know the risk associated with fast driving, okay? And as per the past data, it's a recurring nature that accidents do happen, and that is purely dependent on the speed and your carelessness of the driver. So if I just associate with the speed, that if you're going to drive with the speed of 50 to 100, the chances of an accident is, for example, 25%. If you drive from 100 to 150, that's for the highway, the probability of it would be, for example, 30%. So 30 and over 150, the probability of accident would be whatever would be the differential, 30, 40, 50, 55, and the rest 100 minus 55 is
45.
yeah, yeah. Probability would be 45%, and overall it needs to be 100%. So now tell me guys, now from the past data, I can actually assign to the outcomes, I can actually assign the probabilities. Now tell me, is it risk or uncertainty?
Risk.
It's risk.
Risk.
Oh, these, okay. Now you understand one thing, that the repeated nature, we can actually, that's risk, because the risk can be quantified in that case, and the probabilities can be assigned. But if it's the other way around, so it's uncertainty and the probabilities cannot be assigned. So if a cafeteria is trying to estimate about the daily demand, what could be, whether they're selling sandwiches or burgers or whatever they have, okay? So now tell me, would that be the demand factor? Can you assign probabilities for that? Would you have the past data? Is this transaction a recurring one that happens every day? Can you actually predict the demand with the, and that would be risk or uncertainty?
Ma'am, depends. If the cafeteria is working from quite a time, then they may have the data to predict
Yeah.
values.
That's what I'm talking about. If they have been, if they just started it, they would be uncertain. They can't really quantify. The probabilities cannot be assigned to the outcomes. But if they have been doing it for quite a long time, for maybe 10 months, they started 10 months back, they can estimate, predict the probabilities of the demand with much certainty. Like they can assign probabilities. But if they just started it now, they cannot really assign the probability. So that would be uncertainty. If they have been working for like 5 years, enough data is available, it's a recurring thing. So how to mitigate the risk and uncertainty? So we do see that in daily life, whatever decisions we take, it has got a lot of risk and uncertainty. So how to reduce it? Go search the market, understand the customer requirements, how to do the research. So market research is a systematic process of gathering, analyzing, and reporting data about markets. Okay, about markets, it would tell you data about the customer, the requirements. Okay, so the two type of research. One is the desk research, and the other one is the field research. Field research is the primary data that you actually carry out a research for a particular process, but at times you're just relying on the desk research, which is the research work that has already been compiled by a secondary body, could be a government or could be any department. So that if you're relying on that primary data is costly, but secondary data definitely it's cheap, because you don't have to carry out the whole research process. You have the research reports and you can rely on it. So that's the desk research. So and there are focus groups as well. Just a minute. Okay. Focus group. Focus groups are a small group of people who are interviewed to obtain the qualitative information. So when you're interviewing people, you have seen people interviewing the shows. They go and talk out to the people in the public, and they interview, or they even in the form of shows, or we're doing the panel interviews. So that's they are dealing with the qualitative information, taking their opinions and attitude. And that also helps to bring the uncertainty down, and that also gives you insight into the customer, what product they like, their likes and dislikes, and their definitely their preferences and their requirements. Okay, but when you're doing the research, field research, definitely you're doing some numerical measurements as well. So it could be qualitative and it could be quantitative. Okay, but focus groups is basically used to identify the qualitative preferences. Okay. Now, what are the techniques beside market research? There's another thing that is used for uncertainty prevailing. That is basically the decision rule. So before starting with the decision rule, let's do the expected values. So expected values in which you get the long-term average. So I told you here, if you have this data, okay, now you know the how to calculate the expected values. Let me take you to the board now. How expected values is calculated, and expected value is basically it gives you the long-term average of the outcome, okay, the most likely outcome, and that could only come if you know that you have the past data. So I told you expected value is a good technique in case of risk and uncertainty when you have the past data available. Okay, when you have past data, definitely you would know the outcomes. So outcomes I would denote with X, right? And then you could assign the probabilities to the outcomes as well. Okay, and probabilities I say P. Okay, so I say the demand would be 1,000, it could be 2,000, it could be 3,000. So, and how to calculate the expected values, that what would be the expected demand, what would be the average demand. So, and I would be given the probabilities as well. For example, there is 50% probability the demand would be 1,000. There's 25% probability that the demand would be 2,000, and then there's 25% probability the demand is 3,000. So then you would do how to calculate expected values. P times X of all the outcomes. Okay, these are the outcomes. P times X of all the outcomes. Okay, and for example, here it's 500, 2,000, 25% of 2,000. Here it would be 500 as well, and 25% of 3,000.
750.
750. And then you would take the sum of all, right? Summation Px would give you the expected values. So 500 plus
1750
plus 750 is 1750. So, and you know that on the basis of the expected value, if you're doing the budgeting, for example, I want to calculate my sales revenue, and there was uncertainty prevailing, and that could be the probabilistic budgeting. Probabilistic budgeting, when you're not certain about the cost and revenues or the demand, and on the basis of the expected values, you're taking your budgeted figures. So now how I would calculate the sales revenue here. So I would take the expected demand. So expected demand could only be good when the event is recurring and the data is available, and I could actually, from the past data, I could actually assign the probability. So based upon that, I have taken the expected value. So that's my expected outcome, that the expected demand would be this. And then there may be uncertainty related to this selling price as well, and maybe I would be taking the average price. Okay, for example, if it's 5 per unit, and I think that it's going to be 1750 into 5, so that's how
8750.
Yeah, that's how I'm going to estimate my sales revenue. So expected values you only when you have the past data and the event is recurring. So mostly in the case of risk, I told you guys, like when the probabilities could be assigned. Another thing, now talking about the decision rule. So, and also about the expected values. For example, there are two projects you're appraising. There are two projects. Okay, in the same way, the outcomes and probabilities are given to you. Okay, this is project P1 and this is project P2, and the probability outcomes and probabilities were given like this, right? And you took the product and then you took the sum. So which product you would invest in? For example, the probabilities here, you have done the expected, calculated the expected contribution, maybe expected profit, okay? Mostly decision making is based upon contribution because that's relevant, profit is not relevant. This fixed cost at times is not. So based upon the relevant costing principles here, we would take the decision. So if we say that expected contribution in P1 is 200, that's expected contribution in P1, but in P2 it's 250, definitely you're going to take which one? So based upon the expected value as a decision rule, you would take the project which would give you the highest expected benefit. So expected value, there's a risk aptitude. Now talking about the decision rule, you need to know first of all about the risk aptitude. Okay, whoever is going to take the decision, definitely he would be somebody from the management. Okay, so management is basically, it's a human. So it's a human nature that some humans are like, they're risk takers, but some are risk averse and some are risk neutral. So talking about a risk neutral person first, because we just did the expected value thing. This is he's kind of person who's a risk neutral, who's ready to take risk if he thinks that the average returns are good. Yeah, and but if he would know that the returns are not good, okay, and if the past data would be available definitely, and he has seen people doing it and failing in that project, he won't take that. But if I have seen people doing good in that, he would just go for it because he knows as per the past experiences of different people. So he's a kind of a person who is risk neutral. He kind of approach that balance towards risk and return, willing to take high risk if expected returns are high, and willing to take low risk when he thinks that expected returns are low. So he believes in the good average net return. So he would choose a project that would give him the good average returns as per the past experience. Okay, so he's not a kind of a person who would just be a risk taker, who would just open up a shop in an area. He doesn't know that about the customer, and if the market is good or market, there's a potential in the market. He's not a risk taker because he's kind of a risk neutral person. But if a risk taker is a kind of a person who's a risk seeker, right? He takes high risk. He's got high risk aptitude. So a risk taker person would evaluate the project in such a way, he would want to choose the best of the best. Okay. So he would appraise all the projects. Okay. For example, P1 is one, he could take P2, project 2, he could invest in P3. So all the projects could have the uncertainty. So it could have the uncertain outcomes that have the probabilities assigned. Okay. So based upon that, he would just prepare a payoff table. In that, we need to prepare a payoff table. Okay. What is basically a payoff table? A payoff table is it's kind of a grid like this. Here on you have the decisions. For example, you could take invest in project P1, P2, or P3, and in horizontal, in vertical, it's the decisions, and here in the rows, in the columns, there are decision, and the rows there are real world scenarios. So the world scenarios are basically the outcomes of the decision, and outcomes could be more than two, could be three. That would be an uncertain outcome because you're not sure that the demand would be, in each of the case, demand could be high, it could be medium, and it could be low. So first of all, you need a payoff table for that. Payoff table is kind of a profit table, definitely based upon the accrual basis. So whatever cost you will take the cost of sales, okay? And then sales revenue less cost of sales, and you would take the profit. Whatever would come in the profit, you would take that, right? But in case of salads business, if you know, in case of salads business, the unsold one, those if they're not sold, right? For example, the supply was 700, but you only get to sold 500 salads, right? So here you would take the revenues only for 500, right? But you have actually paid for 700 sellers, and those 200 sellers would remain unsold at the end of the period, and that would be counted as the loss of inventory, because you cannot sell it the very next day, and it would be wasted, and wastages also come in the profit, right? So here only in this case you would take the entire cost of 700, or even if you in sales revenue you take 500, and in cost of sales you take 500, and then as a loss for 200 you would charge in the income statement. So it's based upon the accrual basis, whatever you're making to be as your payoff table. And then this is how you can analyze your different options in the form of a decision, in the form of a decision rule, by applying a decision rule. So what is a decision rule? I talked about the risk aptitude There's a risk taker, then there's a risk averse who has low risk aptitude. What he would like to do, he would just want to minimize the risk. He want to maximize the return, but a risk avoider is a person who want to minimize the risk. So what he would do after making a payoff table, he would just take out the worst case scenarios, and from the worst he would take the best. Okay, for example, in P1, P2 and P3, one worst was -100, another worst was 100, and another worst was 200. So definitely, which one he would take? A risk averse avoider manager would take which product, which is best of the worst, which is best of the worst. So he would be taking which one? P1, P2 or P3?
P3?
No,
P1.
best of the worst. Best of the worst case scenario.
P1.
P1, that's the best of the worst case scenario. Best of worst, right? Best of worst. But a risk taker manager would take best of best. Like in P1, P2, first he would appraise all of the outcomes and the decision, and then he would calculate the best returns, right? P1 has got the best return of 700 in all the outcomes. P2 got the best return of 800 in all the outcomes. P3 got the best return of 900 in all the outcomes. Now he would take best of the best. So which one he is going to choose? P1, P2 or P3?
P3.
Best of the best
P3.
would be a risk aptitude of a risk taker, right? And best of the worst is a person who definitely want to maximize the return, but we first look at the worst case scenarios, because you don't want to take the risk, and he would just want to go, you won't take this, you won't take that, you would take the best of the worst case scenario. So we understood the risk aptitude. Now we are trying to apply the decision rule we talked about. That's one of the decision making technique, which is decision rule. Now we're going to apply, having said that we know the risk aptitude, now we're going to apply the risk aptitude with that of the decision rule. So decision rule is maximax, minimax. It's not minimax, sorry, it's maximin. Here it's wrong. Maximini and minimax regret rule. There are three things here. And both are different people having different risk aptitude. He's a risk taker, very optimistic person. He's a risk averse, very pessimistic. And he's a sore loser. He just don't want to lose anything. So he would just take account the opportunity cost of losing of his decision. Okay, we're going to talk about it. So Maximax is an optimistic person. Risk taker manager wants to avail the option that maximizes the maximum return. So he will take the best of the best case scenario, and he would take the best of the worst case scenario, maximini. Okay, Maximax. Here's a question here. We will do that, and you will get an idea what I'm talking about. Okay, we have three projects, D, E, and F. Maximax, Maximini, and Minimax regret rule. Okay, he is a risk taker. He is risk averse. He is a sore loser. Doesn't want to lose anything in life. Okay, if he thinks that he could earn 10,000, but he opted a project that is giving 8,000, he would always think about he lost 2,000. I wish I could have taken the project with the best return. So he's always a kind of a sore loser who is so pessimistic that he keeps talking about the opportunity cost. He keeps talking about what he has lost in life. So he's that kind of person. And expected values, I told you, he's a risk neutral. He's a risk neutral person. Okay, now Here's a question here. 3 projects we have, D, E, and F, and it's kind of a payoff table. Choices, what choices you have, that's your decision. You could take D, E, and F. These are mutually exclusive projects. One can be taken at a time. You cannot invest in all 3 projects. But it comes with scenarios, 3 scenarios. And that's how we have 1, 2, 3 could be with respect to demand or any other uncertainty. But we have made the profit table and the returns are like this. In one scenario, it's 100. In another, it's 90. And there's a loss. In third scenario, there's a loss of 20. 80 for project E, 80, 120, and 10. 60, 85, and 85. Okay, now first of all, applying the Maximax. Maximax is a risk taker who would want to take the best of best. You want to take best of worst. Okay, now you would start appraising vertically. What is the maximum in case of D? Maximum return. First, you would calculate the maximum return. It's very easy. Go very systematic. First, calculate the maximum return vertically, maximum return in all the options against the decision. So if he take D, in all the scenarios, the maximum return is 100. Here the maximum return is 120. Here the maximum return is 85. So if he is a risk taker, he wants to take the best of the best. So what's the best of the best? Which project he would take?
E.
He would take project E. Very good. Now done with Maximax. Now we're going to apply the Maximini. He's kind of a risk averse person. What you're going to calculate? It's so easy to understand. From the words, first here you calculate the maximum return and choose maximum of the out of the maximum return. Best, like maximum value. And here what you're going to do, first of all, you're going to check the worst case scenarios and best of the worst you're going to take and the best of the worst. So first calculate, just like here you calculate maximum return, here calculate the minimum.
Minimum return.
Yeah, here calculate the minimum return and that is maximin. So minimum here he think is 20. Minimum here is 10. And minimum here is 60. Which project he would choose? A Maximini manager as a first person. He knows that by choosing D in one scenario, he could earn more. But he would just see that in third scenario, there's a loss as well. Okay. Talking about E, he could earn in second scenario 120, but in worst, there is, in third scenario, there's only profit of 10 as well. So why taking 10? Why risking? Why taking 10? When he, in one scenario, the worst is 60, and this 60 is better than taking E and having just earning 10, right? He thinks it's better.
Yes, ma'am.
He thinks it's better to invest EF and take 60 rather than take D and in one chance, and there's a probability of loss as well. So what he wants to do is a very cautious person, just like our parents are. They have their hard-earned money. They don't want to invest. Even if you persuade them to do investment, they say no. Just tell me. They would be a risk neutral. If they think they won't, they're not risk taker. Because definitely because of their age as well, and because they have hard-earned money, they have earned all of their life. Definitely they won't trust you. They won't go with that. So maybe they're like, they would take decision, they are risk neutral, or maybe they're risk averse. But if I had money, I'm young, I know I'm a risk taker, very optimistic kind of person, maybe I would go for project E, because I think that is going to give me the maximum return. So that's about it, right? Understood? Now the third one is minimax regret rule. Here there's one thing additional you need to do. You need to make a regret table, because here you cannot analyze the maximum regret. He's a sore loser, so you want to calculate the maximum regret, okay, out of all the options. He calculates maximum return, he calculates minimum return, and then choose the maximum. What he does is he calculate in all the options. He would first calculate the regret, and then in all the options he would calculate the maximum regret and then choose the minimum, and choose the option out of 3, choose the option that gives him the minimum regret. So idea here is to minimize the regret. Minimize the regret. And what is the regret? He thinks. So regret is calculated as return from best decision minus return from the current decision that he actually took. Okay, just like I was telling you that he see that he could have earned 10,000, but he chooses a project that gave him a return of 8,000, and he would keep sulking about this, what he couldn't get. And that is the opportunity. He would think that is the opportunity cost, 2,000. So how to make the regret table? D, E, N, F, scenario 1, 2, and 3. So now you would see that if in option 1, out of all the 3 projects in option 1, he thinks that if it was scenario 1, he should have earned 100. And if he thinks he in this outcome, the best return comes from D, right? And return from best here is 100, and return from, and if he takes D as well, if return from the current decision is 100 as well, he didn't lose anything. Here the regret would be 0. But if it was scenario 1 and instead of D he took E, what's the regret here? What he lost? He could have earned 100, but he chose E, that only gave him a return of 80. And what's the regret here? Regret here is 100 minus 80. Regret
20.
20. But if he thinks it was scenario 1, and instead of choosing the best return, best project, D, that could have given him a return of 100, he actually chose a project. Currently, his decision was F. So what he lost here? What's the regret?
40.
40. See, that's how you're going to calculate the regret one by one. So the formula, remember the formula, and go horizontally. Okay. So when he thinks that the outcome, it was scenario 2. So in scenario 2, what's the best in which you won't have any regret? What's the best? If it was scenario 2, it was good to accept D, E, or F. You guys tell me.
E, 120.
E. So if he chose, the best return was 120 and he chose 120 as well. What's the regret here?
0.
Here the regret is
0.
0. But here he chose 90. The best was 120. What's the regret here?
30.
30. 30 regret is 30 is the regret here. But if he chose 85, however, the best return was 120. What he lost here?
35.
35.
35. Very good. Now you understand how to go about it?
Yeah.
Okay. Now you can do the third line yourself. If it was scenario